Welcome to Opales TV. Today we're visiting Ironshield Capital Management in London, a special situations investment manager focusing on stressed and distressed event-driven credit situations in Europe. Founded in 2007, Ironshield has one of the longest and most successful track records in credit investing. The team is one of the most experienced European distressed groups in Europe and runs a range of attractive strategies spanning the liquidity spectrum. So David, great to be here. Please introduce yourself and your firm.
My name is David Nazar and I'm the managing partner of Ironshield Capital. So we're a hedge fund, we're based in London, and our area of specialism is investing in low-grade credit. So that's anywhere from normal high-yield investments, bonds on an event-driven basis, right the way through to distressed credit, which is obviously at the very bottom end of the credit rating spectrum. I started Ironshield, which is in 2007, so that's 16 and a half years. And in total, I've been doing that for 2 decades. I worked at investment banks prior to that in the same strategy. So that's our specialism. We have a team of dedicated people who help execute that strategy with me. Our goal is to deliver very good risk-adjusted returns to investors.
Just going back when you started out, what made you launch Ironshield?
I launched Ironshield for the same reason a lot of other hedge funds were launched, that the regulatory burdens on investment banks making investments in my space were increasing, and the freedom that a hedge fund allowed investors such as myself to make investments, it meant that I could create a lot more value for my clients. So that was the reason to launch a hedge fund.
Tell us also more about your team. How do you work together?
Because we are a analysis-based strategy rather than a trading-based strategy, I think a key component for being successful at this strategy is being able to focus and not deviate from that focus until you get to final answers and you've peeled back many, many different layers of analysis, story, fact, until you understand the key drivers of what is driving a potential risk-reward, a potential trade. And I think that a key mistake that people can make in our space is to be satisfied with answers which on the surface appear to make sense, but they haven't been questioned enough. The thesis hasn't been pulled to pieces. There hasn't been an interaction, between different members of the team to try and understand if that credit thesis actually works or not, or whether there's a deeper story. And so that's what I think the key personality characteristic is for being successful in our business. In terms of the team and how they're empowered to do that, we're a team of equals. Everybody has a place to question the work that we do. We discuss credits as a team. Obviously, individual people will do the individual credit work, but then that's thrown out to the wider group to discuss, and as I said, to analyse and to pull to pieces and see if it makes sense and see if that thesis itself is stress tested. And I think people in the team having that direct control on shaping the portfolio is a very attractive experience for them. And I think you don't get that with a lot of investment strategies, which maybe are more hierarchical in terms of decision making. And that's also the strongest way of making decisions. So obviously we can create the best return stream for our investors using that process.
This is a very demanding, specialized strategy. Tell us more about your culture. How do you work? How do you research? How do you invest in this sector of distressed credit?
Well, that's a good question. I think the culture is highly analytical, and I think we're in a space, and part of the reason that I like this space is it is very intellectually demanding. It is an analysis-based strategy rather than a trading-based strategy, or there is part of the strategy which is related to trading, and it involves a lot of research into companies. We will spend days, weeks, months looking at companies. Sometimes we look at companies for over a period of years before we make the first investment. Sometimes we look at companies over a period of years and make several different investments at different times. Be able to continue that dedicated focus on individual companies, to be able to fully understand them, because that is what creates alpha. And our understanding of our competitors of particular situations is what does create the alpha. The good thing about the area where our strategy is that you really can be the most expert set of eyes globally in a particular situation. So it does get that rarefied, even if the community that's actually trading that situation is wider than that. And that really allows you to create some great returns, because clearly that understanding and being ahead of the competitors, it does lead you to great risk-adjusted returns.
Let's go a bit into the details. Tell us more about the actual asset class and the instruments that you trade.
So there's two main instruments that we trade in. One is bonds and one is loans. So those bonds and loans tend to be incepted, although not always, but tend to be incepted as leverage loans and leverage bonds. So they are, for instance, from private equity type capital structures. Occasionally you do also get fallen angels, which were investment grade loans and bonds, which come all the way down to stress and distress level. We also look at those as well. So those are the basic two instruments that we trade in. What we do is we look for events. So we typically will turn our book about 2 times a year. So on average, obviously, that is about a 6-month event horizon. So we're looking at events in individual credits that will change the price, and obviously looking at those to call those correctly and to create alpha out of those events.
And just in general, what would you say is special about your strategy?
Well, from my perspective, I love it. I think it's super interesting, and it allows you to really understand both corporates, value, capital structures, cash flow, all those basics, but all wrapped up into one strategy. And so you have to be a master of all of the different aspects of finance and valuation, which I think is really interesting. And then I also think creates the barriers to entry, because it's difficult to assemble all of those skills in one place to be able to execute the sorts of trades and investments we do. And I think that's why it's an interesting strategy, and that's why I think it's different to a lot of other strategies which you have to be expert on, but maybe expert in a particular silo of investment without a broader view of all aspects of investment and finance.
And how would you say are you different from your competitors?
Well, I'd say firstly, if I think about our competitors in Europe and the specialists who are just focused on Europe, which I think are our true competitors, firstly, there's not that many of them. Secondly, I don't think any of them have the longevity of track record that we have, and I suspect none of them have the IRR that we've created with the Sortino ratio that I talked about already. So I think track record puts us in a different place to our competitors, and it's already a pretty rarefied field. Competitors. I would also say that our process, which has been developed and honed and is still being developed and honed over many years, we never rest in terms of improving what we do, is rigorous. It's steps based, so we have the same process every time. We put the outputs and inputs into the same format, and that also allows us to track the performance of the decisions we make. So it's not just an overall IRR on a portfolio, but it's actually performance of individual decisions that we're making on individual credits. And we apply credit statistics to that to understand the sorts of credits that will be positive addition to our portfolio, and the sorts of credits that are frankly priced wrong and we should avoid. So I think all of that together, I suspect, is pretty rare or unique in terms of how we manage the portfolio, and it produces the output that we've talked about.
And why is the main focus Europe?
Well, the main focus is Europe because I was born here. So it's a historical reason, and I started my career here and I've become expert here. But I also think that Europe is a much more fragmented market than the US. You have many different jurisdictions, each with its own bankruptcy process, and whether a company is distressed or maybe just a risky credit and not distressed, one always has to consider the downside of what would happen in a bankruptcy. That's obviously part of the analysis and the most important part of the analysis. So because of that fragmentation of the market, I think what that does is it creates a much less efficient market with bigger pricing dispersion. And that's one aspect of it. So I think there's more opportunity in Europe than there is in the US, or I reword that, there's more opportunity to create alpha here than there is in the US. So that's one aspect of it. I think the other aspect is, as I mentioned before, there's less competition here. So that certainly helps. And there's a third aspect, which is if you look at the bankruptcy processes, so if you look at European processes versus Chapter 11 in the US, the European processes tend to be less adversarial than Chapter 11. So Chapter 11, the characteristic is more towards becoming a bigger creditor and becoming an activist creditor, whereas in Europe it's more towards being an analytical investor, because there's less of a differential between outcomes for different creditors at the same level as there is in the US. And I prefer the analytical approach because I think that's a much more efficient way to make money, because as soon as you become an activist, which we do sometimes when it pays us, that's a much more time-consuming and resource-consuming activity for not necessarily adding any more alpha.
Now, I was wondering, what drives you doing your job?
To me, it's every credit, however difficult it is to understand, however maybe beaten up it is because it's distressed, has a price. And with a lot of the credits we're looking at, the market struggles to find that price, and we can find that price. And that is really interesting for me, to be able to do that, because you come in with a sort of shapeless mass of sometimes contradictory information and incomplete information set, and actually navigating a way through that to come up with a rational, probability-based answer in terms of what a piece of credit is worth is a really interesting process. So that's what drives me to come in every day, because obviously I've got a job that, as I say, is very interesting.
And how do you manage risk? What is your ethos around risk?
So we look at risk in two ways. Firstly, as an absolute loss that we're willing to risk on a particular credit. So obviously we model different scenarios for different credits, and we'll size a position such that it won't trigger certain parameters in terms of a maximum loss. That's one way. The other way is more statistically, when we model them in terms of how they fit in our portfolio, and we're calculating variance and standard deviation on different scenarios as well, allows us to control risk in individual credits and the overall portfolio. And I think the results of that, are our Sortino ratio, which I mentioned before, which is obviously extremely high at 2.4. And the other thing is just, if we look at the number of credits we've invested in, which is probably around 300 since we started, I think we've lost more than 2% on a handful of those, so maybe 4 or 5. So, we have a very, very good track record of controlling downside risk. And when I think about the investment process, the split of time between looking at upsides and looking at downsides is probably about 10% to 90%. So generally speaking, the upside is relatively clearly defined and we spend our time working out all the different ways that we may not get that upside. And obviously that's part of the process that we go through to understand whether a credit at a particular price is attractive or not.
And also, why do investors invest with you? What benefits do you offer?
I think investors invest with us primarily because they've decided they want exposure to our market. And then once they've decided that, they're looking at probably a track record, which, as I mentioned, obviously is an IRR and a Sortino ratio or a Sharpe ratio. And then I think we obviously look very good in that comparison. And then I think what they're looking for is someone with a repeatable process, which again we have and we can demonstrate. And then I think the last thing, and probably the most important thing, is trust. So investors want to trust that the people in our business are going to continue to make well-balanced, reasonable decisions in the pursuit of creating that return stream that they're looking for. And that's why investors ultimately will pull the trigger and allocate to us.
And how would you characterize the opportunity set for your strategies at the moment?
I think the opportunity is increased in a multi-dimensional way. So firstly, there's more credits that the market is going to have difficulty pricing because they're either stressed or distressed or riskier than the market perceived before. So there's numerically more, but also there's more dispersion because it's more difficult for the market, which is no longer in a steady state, to actually price each individual credit. So it's more numerous, more dispersion within each credit. And the other thing I'll mention is that when I started out, the European high yield market was about 100 billion in size. And now it's about 7 times that. And the leveraged loan market is probably something similar. So you've had an incredibly aggressive expansion of leveraged credit over the last decade. And the reason you've had that is because rates are so low, many more companies could afford that leveraged cat stack because the risk-free rate was basically zero. So you've got a very significant change in the cost of debt coming at a time when you've got a record ever level of risky credit, of sub-investment grade credit. That's what makes our space so interesting. The outlook is extremely interesting for our strategy, and I think that's a medium to long-term outlook. And the reason is because if you look at the last 3 decades, 3 to 4 decades, what's happened to risk-free rates, i.e. government bond yields, is that they've declined very steadily. So if you look at the German Bund 3 decades ago, that was 9%, and it went down to obviously 0 and below 0. Now what's happened is you've seen a sharp reversal of both short-term and long-term risk-free rates, government bond yields. So if you looked at that on a chart, you would see that that's quite a startling change to the regime that's happened over the previous 3 decades that ended in December 2021. So with risk-free rates higher, it makes debt more expensive for every company and every person. And when you think about companies, if you're investment grade, now you don't want your debt to be more expensive, but generally speaking, you've got low leverage and you can easily afford the interest. But when you come to sub-investment grade, where we specialize, and particularly stressed and distressed, often the new interest rates are unaffordable for those companies. And to make them affordable, there has to be a restructuring of the balance sheet. And a restructuring of the balance sheet is a distressed situation, and that's what we specialize in. So we're predicting there's going to be a lot more of those, because not only are rates higher than they were, the direction of travel of rates after 3 decades of going down is now different. And the market is telling us that long-term rates are also higher. So the entire world, and certainly the sub-investment corporate space in Europe, up until December 2021, which is when rates changed, the direction of rates changed, was geared to a very low interest rate world. And now it's not. And that process of right-sizing capital structures, changing capital structures to be able to cope with the higher cost of debt is a process that we can make money in, because that process necessarily involves stress and distress, and that's why our space is so interesting at the moment and will be for many years to come, we believe. So to summarize what I've just said, the end of free money means that corporates are going to have problems, and we specialize in corporates that have problems.
I think you're offering a range of strategies. Can you tell us more about those?
So we have a range of funds. So we have UCITS funds, we have hedge funds, we have a lock-up fund as well, and that spans the liquidity spectrum from daily all the way through to the lock-up fund, which is obviously a multi-year lock-up. We can take advantage of investment opportunities across the range of different spectrums and across the entire range of the sub-investment grade credit universe.
Tell us also more about your investor base.
I really enjoy my interactions with clients, and the fact that they trust us with their money makes me extremely proud and happy, and I like that interaction that I have with clients and delivering a service. We tend to have long-term investors, and even on our most liquid funds we have long-term investors, and I think that's because our strategy it's not the easiest strategy to understand. It's quite a lot for investors who are generalists, looking at lots of different strategies to take in when I explain what we do to them. So I think once they've done the work, they tend to stick around, and obviously sticking around is part and parcel of the service we provide to them, which is not just the return stream, but also the communication, the open access they have to us, the sort of interaction they have with us, our transparency, and so on and so forth. So we have many relationships which are many years old.
I was wondering, is AI becoming a force in your investment process?
We're looking at how we can use AI along with a lot of other people in our strategy, and I suspect we will be incorporating it at some point. I can't tell when that point is, but the fact that we have quite a standardized process that could be amenable to some sort of AI input at certain stages, or maybe the whole chain, is something that we're looking at very, very carefully. And the advantage of any mechanization, which is productivity increases, and our productivity will increase. So we're going to be able to look at more situations on a wider scale, more rapidly, and that's both offensive in terms of us producing an even better return for investors, but also defensively because other people will be doing the same kind of thing. I would say that I think our strategy is one of the ones that's going to be affected by AI later, just because of the huge amount of different sources of information and how the different ways in which that information can affect the outcome. Obviously, AI is there to process huge amounts of information, but I think it's going to be more difficult, or it's going to take longer to structure AI to deal with that than it will be with maybe some more narrowly focused strategies. But I think it will definitely be a part of what we do at some point going forward.
Like a lot of hedge fund managers, you're of course incredibly busy. I was wondering, what do you do for fun?
I actually don't do things for fun. I do things because they're the right thing to do. So if you're asking what I do outside of work, I've got family, I've got kids, and that keeps me pretty busy. But I wouldn't say I do things for fun.
Okay, so you focus a lot on making good decisions. Can you tell us more about that, your decision-making process?
I mean, making a good decision means being right, or giving yourself the highest probability of being right. And I think you won't know if you're going to be right, but you can know if you've made a good decision even before you know if you're right or not. Because the symptom of a good decision is that you've balanced all of the available information and analysis carefully, leaving nothing out and no component out, you have an internally consistent answer. So there's no contradictions to the data set in terms of how you're interpreting the data set internally. And it's externally consistent as well. There's nothing outside the individual decision you're making that would suggest that it's wrong or has a different probability of being right or wrong than you think it is. So I think that's the way to make right decisions. And our product is, or good decisions. Our product is good decisions. And then, of course, you have a dispersion of outcomes around that. But that's how I think about our product. It's good decisions. And what does a good decision mean? It's a price in our world. It's a price where you think the fair value of a piece of credit is. If it trades above that, you're a seller. If it trades below that, you're a buyer.